Okay, well, thank you very much for having this our paper on the program. The paper is joint with Michael Graber, who's here in the front row, a student at UCL. So the paper is about human capital accumulation, labor market frictions or job ladders, and consumption inequality. And I guess the other thing I should do at the beginning is thank the discussant for in advance for, I'm sure, going to be a very insightful discussion based on pretty short notice and sort of a paper that's just equations and some figures. But the paper, sorry? No pressure. So the paper's a little bit preliminary right now. So for the purpose of this talk, I'm going to keep the question very narrow, very specific, and something we can kind of focus on. So one of the things we want to have something to say about are what can we say about the relative contributions of shocks to human capital versus the stochastic process of the job ladder in determining the uncertainty that workers face in the labor market. In the sense that we can think that there's some uncertainty about where and when workers can get jobs. There's also going to be some uncertainty about how workers accumulate human capital. We're going to be trying to get towards an answer on this, and we're going to be motivated by a couple of figures from the literature. Okay, so I'm going to start sort of trying to motivate what we're doing and why we're doing it with these three pictures. Maybe I can zoom in on them. So this top picture is a pretty well-known picture. This is we pulled this one from McGeer and Pustafari handbook chapter, and they're plotting here against age or experience the variance of log earnings and the variance of log consumption over against age. And sort of the things that especially these authors and what people take away from this is that we see this approximately linear rise in the variance of log earnings with against age, mirrored by lower slope and lower level, sort of approximately linear rise in the variance of log consumption with age. And the facts that these are increasing and approximately linear tell us something about the nature of the shocks that individuals are facing. So one way to get this rising variance in earnings with age, there's a couple ways to get it. One is going to come from sort of lots of heterogeneity across individuals in sort of ability as well as in the ability to accumulate human capital. So that's going to give you a fanning out. Another obvious way to get that is to have an income process where there are very persistent shocks. Random walk is going to get you that quite well. So the reason for putting both of these lines up here is that once we look at once we get the information on the linear rise in the variance of consumption, that tells us something about how individuals perceive the risk. So if we're viewing that through sort of the standard life cycle permanent income hypothesis, this is going to tell us that when individuals are making their consumption decisions, they're at least acting as if they're facing very persistent shocks. Okay, so that tends to work towards the story of a very persistent shocks. If you want to work the story of the profile heterogeneity in there, you need to layer on something about uncertainty that individuals have about their profiles. So Fatih Guvnin has a story about learning about your profiles. But what you need is something in there that makes individuals at least behave as if they're facing something very, very, very persistent. Whoops. Uh-oh. So that's one of the this is not working. Okay, so I'll leave them like this. The other pictures that we're going to have in our mind are pictures that come out of very recent work from Fatih Güvenin and his co-authors based on Social Security data. So they have data on millions of US workers, so they can get very precise information about not only means and variances but higher order moments. And the things that come out of that paper are a couple of striking features of features of the higher order moments of earnings changes, year-to-year earnings changes. So the left-hand picture here, taken directly from that paper, plots on the vertical axis here the skewness of year-over-year changes in earnings against the percentile of the recent earnings distribution. So you can think of this as plotted against YT in this difference between YT plus 1 minus YT. And so the thing to note here is that everywhere the skewness is negative. It becomes increasingly negative as we condition on higher and higher points of where in the earnings distribution the worker was. And it becomes increasingly negative if we condition on age or sort of years in the labor market. They have a similar picture drawn for the kurtosis of those earnings changes. So again, with the same growth in earnings year over year against where the individual was in the year T distribution. And here we see the kurtosis of that change is much higher than normality. It's increasing in where you're conditioned on where the individual was coming from the period before, or where the individual was in the distribution the year before, and it's also increasing with age. So these are kind of quite striking new patterns that we see in the earnings data. One natural, okay, so what do these two pictures tell us? They tell us that the very high kurtosis tells us that most of the earnings changes are small and close to zero, and the very negative skewness tells us that those ones that are far away from zero are more often negative than positive, right? So one kind of natural candidate to generate changes like that is going to come off of a job ladder, where as individuals climb higher and higher up the job ladder, they most of the shocks they get are sort of moving up little by little, and the large shocks they face are falling off the ladder and sort of erasing their range. That's going to give you the skewness and these kind of features. At least qualitatively, it's going to go in this direction. So one thing we want to do is see, quantitatively if the model is going to be able to get anything like that. And we also want to make sure that the model is going to be consistent with the picture like this.
It would be more useful if you don't have kurtosis. If you have a picture of the right-hand corner of a bell-shaped thing and show how changing the kurtosis from the bottom curve to the highest curve, how much difference it makes.
So I missed the first part of the
We're
question.
talking about some kind of bell curve.
Yeah.
And you're saying this is really a big change in how that curve is, but those pictures don't show that.
They don't show you that. Okay, fair enough.
Maybe have a normal curve.
So a normal bell curve, the kurtosis should be 3, and it should be flat across here,
Yeah.
and the skewness should be 0.
I can see, but we're not making that.
What's that?
I can see we're not making that. I agree.
Yeah. You want to know
How big a deal it is.
Okay, I don't have that picture, but I appreciate that that's so Güvenin et al. Have that picture. It looks completely different. Okay, and I don't have that slide. There was a question
These
here.
are one-year transitions. My understanding from Kaplan is that there's a fair amount of bounce back. If you get hit with a negative shock, are you going to look at 5-year transitions as well?
I'm not going to look at 5-year transitions only because I haven't progressed that far. Okay. but that would be a natural source of more information. I agree. Okay. So there's a large related literature on statistical models of income processes. These recent ones, the Guvenen et al., were the pictures I just took from, and Ariano, Blundell, and Bonhomme are versions which are focusing a lot more on the nonlinearities and the higher order moments, sort of that we think are going to be important here. There's a set of papers that are related to using choices that individuals make, viewed, filtered through a model to help learn about what types of risk agents they're facing, what's in their information set, et cetera. So that's we're going to lean in that direction. That's the reason we're going to be pulling in a consumption model into the job search model, because it's going to be very informative in sort of telling us about the nature and the persistence of shocks. And then, of course, we're going to be related to this to the existing literature that relates human capital accumulation to job search. We saw papers right before lunch that would be in this literature. I hadn't seen it yet, so it's not on the slide. The main interest in all of these literatures, in these papers, is about the sort of the mean profile. Okay, so where we're going to differ very, very much from that is we're going to be looking at those higher order profiles where there seem to be a lot of interesting things going on. Okay, so the model's going to be a search model. It's going to be continuous time with the risk-averse workers who are discounting the future. Rho will be the subjective discount rate, and we'll have a rate at which workers leave the market. You can think of it as retiring or something like that. And just to keep things stationary at the aggregate, we would replace them with a newborn identical worker at time 0. Okay. So there's going to be on the job search here. So workers are going to be looking for jobs when they're unemployed. They'll be looking for better jobs when they're employed. On the firm side of the model, we're going to be informing the model with matched worker firm data. So we do want to have at least something going on there. Firms recruit here is probably not the right word. They're going to be, workers are going to be sampling firms from a sampling distribution. The real action that firms are going to be doing is that they're going to be making offers to workers, and they're going to be making counter offers to try to retain their existing workers. Okay. So that's going to give some additional wage dynamics at the firm level. Okay. There's going to be heterogeneity on both sides. The workers are going to differ in terms of their ability, their productivity, their ability to learn, how quickly they make contacts, et cetera, et cetera. There's going to be a fair amount of heterogeneity there. And firms are also going to differ based on their productivity. And we're going to assume that they may also differ in terms of the amount of human capital, the rate at which workers can accumulate human capital while they're there. But we're going to make an assumption that we're still going to be able to order firms with a single index, which I'll talk a little bit about later. Now, to get some, or to at least allow the possibility that there's some interesting interactions between what's going on with the human capital of the worker and the job ladder, we're going to allow the rate at which workers accumulate human capital to be related to the particular jobs they're at. So they may differ themselves. The jobs may also differ. They're going to differ in exogenous ways. So it's going to look different than the paper we saw before lunch, where that training decision was endogenous. And the human capital accumulation we're talking about here is just a single type of human capital, which will be a general human capital. Okay. So the consumption model is going to come off of an environment where we have incomplete markets. So workers are going to be doing precautionary savings, and that's basically going to be their only form of insurance against shocks. Okay. Some specifics about what's going on here. Technology is going to be assume that it's the product of the worker's human capital and the productivity at the firm. So we're going to think of a worker as having H0 and an H1, where the distinction there is H0 is going to be permanent, H1 is going to have a T subscript, and it's going to be the bit that's evolving over time there. Okay. So market production is just going to involve that interacted with the firm type, and if the worker is currently not employed, it's going to have a home production function that is of a similar form, but with B replacing what's going on at the firm. Okay. So the human capital is just going to be it's going to be an exogenous process that may depend on this where the worker is and the heterogeneity in the worker. So we're going to allow the change in the human capital. We're going to allow the drift rate to depend on her type, as well as the type of the worker that she's employed at. And then there's going to be a Browning motion, the shock process with the variance sigma here. So the drift process, at least in the way we're going to parameterize it later, is just going to be additive in the worker type and the firm type. You could imagine an interaction there, but it proves to be difficult to get much traction on that. Okay.
So there's nothing that keeps H1 from becoming negative then?
There's nothing that keeps H1 from becoming negative.
It's logged actually.
Oh, the left-hand side log of H1?
Yeah.
Okay. Oh.
It steals the log of H1.
Sorry, okay, my apologies. There's a typo on the slide. Okay. So the contact rates, we're going to allow to differ depending again on the worker type. The gamma is going to represent the sampling distribution over firms that workers draw from, both from when they're unemployed and when they're employed. And again, we're going to allow the separation rate from employment into unemployment, again, to possibly differ by the worker type. And at this point, we're just going to have a constant rate at which everyone leaves the labor market, retires, whatever you want to call that. Okay. So wages, we're going to model wages in terms of a piece rate. So the wage for an individual at time t is going to be the match output, which was H0, H1t times y, times the piece rate that's existing at that point in time, theta t. So, I mean, without putting any structure on theta right now, that doesn't restrict it much. We're going to require theta to be between 0 and 1. This is going to give us a log wage equation that has this attractive empirical form in that it contains something that looks like a worker fixed effect, a firm fixed effect, and then two bits that are sort of stochastic processes that are going to be correlated with the worker effect, the firm effect, and once I tell you how theta is determined with other things prior outside the match as well. Okay. So we're going to assume that the piece rate is set basically by two firms negotiating to try to hire the worker. The worker is going to go to the firm where productivity is highest, and that firm is going to pay the worker, is going to set a piece rate to pay that worker a wage that would give them the entire flow output at where they're pulling them away from. Okay. So that gives a very simple expression for what the piece rate is going to be at the start of a match. If a worker moves from a firm Y to Y prime, the piece rate at the beginning of that match is just going to be Y over Y prime. if the worker is currently at a firm Y, is approached by a firm Y prime, but the productivity is lower, the piece rate may get updated. It might stay the same, or it might get updated to Y prime over Y. Okay, so that's going to put some additional upward pressure on wages.
These aren't the level of the wage that leave the worker indifferent. This
you-
isn't the level of the wage that would leave the worker indifferent.
That's correct. So, a couple comments on this. So this theta that they're going to negotiate is one that would satisfy the participation constraints of both the worker and the firm, but it's not going to be an optimal theta in the sense that it's not going to be chosen so that the worker, in terms of values, is indifferent between staying in the match and leaving. The reason that we went this way and stayed away from the other is that the model is going to be one where workers are making consumption savings decisions. They have an asset position, and in order to do that indifference then we require that the firm also know the asset level of the worker, et cetera, et cetera. At least that's a likely outcome. So we preferred to go with something simpler. It's also chosen for transparency in the identification and the interpretation ex post, but I will definitely concede that if you are looking for the optimal wage, it's not going to be delivered this way here. Sorry?
I would just cross off the line saying Bertrand.
Fair enough.
And how's the wage set coming out of unemployment? Coming out of unemployment, how's the wage set?
Then it's going to just be replace the Y with the B. So the
B is homogeneous though?
The B is homogeneous across the individuals. So what's going to be heterogeneous are going to be the H's. So there's going to be this proportionality here.
Just to understand Rob's comment. So that means there will be sometimes meetings where I meet a firm Y prime. I would prefer moving to firm Y prime given the offer by a state with firm Y, because the mechanism tells me you're with firm Y, you can't go to firm Y prime. Is that
No.
So if this is not a point of indifference,
So the transitions are still going to be efficient. It's just that the value that the worker is going to get upon being hired or making the transition is going to be higher than their reservation value. Okay. Giving the worker their reservation value. Right. Okay. So the Bertrand thing can be scratched off there.
The difference is that the firm with Y prime higher than Y is also offering better human capital accumulation possibilities.
That needs to be at least weekly higher.
The worker who's moving,
Yeah.
he would actually accept a lower.
So there's that point. There's that point as well. Yeah. So there's a few, and in addition, the worker is risk averse, and so they would prefer something other than the piece rate. So there's a set of reasons why this is not optimal. It is, however, going to give a wage that's in the set of wages that satisfies everyone's participation constraint.
It's efficient in the sense that the move is efficient.
The move is efficient.
The surplus is split not in the Bertrand way, in some other way.
Correct.
So, but it's still on the Pareto frontier.
Okay. So given those model ingredients, the value to a worker, and this we're using to figure out the worker's consumption path, and which is going to be informative for how the worker views the different types of risk, contacts, shocks, et cetera, in the model here. So W here is the value to the worker who has assets A, ability H0, her current human capital is H1, working at a firm with productivity Y at a piece rate of theta, and we're discounting at the subjective rate of counting the rate at which the worker is going to make a contact with another firm, the rate at which the worker separates into unemployment, and the rate at which the worker exits to unemployment. So the right-hand side has the worker choosing consumption. U of C is the utility flow from consumption, which we're going to have as constant relative risk aversion. And then we have the value changing for a bunch of different reasons. It's going to be changing because the worker is saving or disk-saving, so we're going to be valuing that at the marginal value of assets. The third line here is about the value changing due to the human capital accumulation. The first component is the deterministic one. Second component is the stochastic component of that. This term here is the change in value and expectation when the worker contacts a firm, another firm, and either moves or renegotiates her wage. And then the last line here is the change in value, again, an expectation associated with a separation to unemployment or a transition out of the labor market. Now, one thing that's not in the model that that probably should be there, and I think having looked at how much we get out of what's currently in the model is probably gonna help in getting towards those pictures we showed at the beginning of the presentation, is some possibility for some loss of human capital in transition to unemployment, right? So the way we set it up is the worker loses the search capital that was embedded in the firm that she was matched with right before separation, but we don't have her losing any of her actual human capital. And this is maybe a quite important type of shock, sort of the Lundqvist-Sargent type shock that we know is can be quite important. Okay. So I won't talk tons about the data, but the data is matched worker firm data from Germany, spans a long time period, 1974 to 2010. The version that we're working with is a 2% sample of the whole thing. And then we're going to supplement that data with aggregate data where we can get information about the sort of age profiles of income and consumption. But it is going to be informed by this matched worker firm data. In terms of how we learn about the parameters of the model from the data, I'll sort of give this heuristic discussion. We're going to learn about the worker types or the heterogeneity across the workers, essentially from the first wage that they take out of unemployment. Firms are basically going to be ordered based on the rank of their hires from other firms relative to total hires. Higher ranked firms are able to attract more workers than lower ranked firms. And then we can get this sampling distribution over those firms directly out of jobs taken out of unemployment. There's no selection on that margin. Okay. The transition rates are identified in the usual type of way. We're just going to condition on type here. And then the bit that's a bit more tricky is the human capital accumulation process. We can identify that whole process essentially by having 3 spells and looking at the difference in the starting wages between spell 2 and spell 3. And then we use spell 1 basically to condition out everything that was going on before the beginning of spell 2. And it's especially helpful if we have workers who are transiting between spell 1 and spell 2 within the same class of firm types. Okay. So we do find substantial cross-sectional heterogeneity in the worker types, and if we condition on education level, they sort of first order stochastically dominate, as one might expect. The picture for firm types is not that informative because I've plotted this in terms of the rank, but there's substantial dispersion there as well.
So you're assuming that there's one labor market for all workers, and all the firms are producing the same thing, though at different rates. What happens if that's not true, which is probably the case?
So yeah, separated by education, but beyond that, yes. But what was the question other than that's probably not true?
So we have chemical firms and we have mining firms, and people are stuck in their industries. That's good. Good result for you, saying. You're assuming that they're facing a distribution which they're not actually facing on both sides.
That could be. I agree that could be problematic, and the extent to which we can condition down, it may be sensible to do that. I'm perfectly open to that. So the numbers that you're going to see are going to be conditional on, as you said, sampling from the same distribution.
And you could see that by the transitions that you see in the data, right?
I agree. That's a good point. Thanks, Steve. 12 minutes. Okay. Right. So I don't know if these numbers are all that informative. One that's kind of interesting is something that comes out in the human capital accumulation, that the drift component, the parameter is negative, so there's a negative correlation between the level of the ability of the worker and the rate at which their human capital accumulates. This is, anyone who I know that has estimated a model where you have heterogeneity in slopes and intercepts. This is kind of a robust feature that comes out of there, so it's not so strange. And the variance of the shocks look approximately like what we would get out of what we would expect there to be. I should highlight that these numbers are pretty preliminary, so I would expect them to change. I'm going to show instead pictures of what comes out of the model once you simulate given those parameters, and relate that back to those pictures we showed at the beginning. So this is a simulated picture of the variance of log income, the variance of log consumption against experience or years in the labor market in our model. And the model produces, pretty much exactly this strong linear increase in the variance in income, the linear increase in consumption. That's about, with the slope that's about half as much, and the amount that's of the rise looks about right. So that part is a plus. We get the model delivers the negative skewness of year-over-year earnings changes everywhere, and when we condition on the percentile in the wage distribution, we do get this increasingly negative pattern. The numbers here, the magnitude of the skewness is less than the number that I showed you from Guvinen et al. in the U.S. data, but certainly the pattern is there, and we don't get this what we see, if you remember seeing in the data, right when you got up to the top, everything kind of went non-monotone. I have no idea how to think about that pattern. The model also produces the excess kurtosis that's increasing again with the percentile of the wage distribution. So that story of the job ladder is working to produce those things.
Do you also generate kurtosis for stairs? You also have kurtosis for stairs.
I believe yes. We looked at that quickly last night, and it's fuzzy in my head. Okay.
But the numbers for the kurtosis here are a lot smaller than.
These are a lot smaller than those other numbers for sure. Yeah. So this plot would look less different from the bell shape than the actual data. But at this point, I'm not going to defend that hard these numbers because of the preliminary part of it. I'm optimistic that we can get them bigger, especially if we stick in that red, the Lundqvist and Sargent kind of shock. But I don't have, I can't show you that at this time. I can.
Are the kurtosis numbers in the German data the same as in the American data?
They're smaller, but the model numbers are smaller than the data. So another thing we can have a sense about, and this is again more of a qualitative statement, is in the pictures I showed from the U.S. data, we also had this pattern that the negative skewness became even more negative, and sort of the lines shifted parallel down as you went up with age. The model gives you that, but only if you compare the guys who have less than 10 years experience to the rest. Okay, so that feature is only there early on in the data, and that's coming from the job ladder combined with the rates at which the estimated rates at which people switch jobs gives you stationarity pretty fast. So that's you get sort of qualitatively this, but not after that. And that is one of the reasons why we think we need something shocked that's more permanent than just your position on the job ladder. You get a similar kind of very qualitative statement on the kurtosis side. Okay. Just to quickly in the last 5-7 minutes give a breakdown of what's generating the patterns in the what's doing all of the work in generating these profiles. So what's plotted in the first one is the variance of log income, which are the top lines, and the variance of log consumption, which are these lines right here. And then we do the following experiment of shutting things down. The first thing that we did was shut down the heterogeneity across workers in output, and that basically drops the level down. The next thing we do is get rid of the growth rate heterogeneity. It doesn't change the slope very much relative to just getting rid of the intercept heterogeneity. The third thing we do is get rid of differences across firms. So all firms look identical. That's this green line here. That drops the slope down a bit. So that movement across the firms is generating some permanent or some fanning out of the distribution of earnings as these workers age. But if you look at the profile for consumption, it actually becomes more linear, if anything. So the workers are not perceiving that as very permanent risk. It's there contributing, but it's not something that they really consider permanent risk. And it's only when you get rid. It's only if you take out that shock to the human capital accumulation that you really drop that variance down to something that looks very flat. So sort of the main takeaway from here is basically all of this rise is due to that persistent shock component that we put in the human capital, and almost none of it due to the job ladder. Things look completely, go the complete other way when we look at the skewness and kurtosis. It's when we take out, we can take out everything about the workers and not much changes either in the profile for the skewness or the profile for the kurtosis. It's once we shut off the job ladder that then we have zero skewness and a flat kurtosis at 3, and we're left with basically the normal shocks implied by the human capital accumulation. So those, we put a fair amount of possibilities for interactions in there, but it really seems to be that these two features are coming off the job ladder, and that first feature is coming off of the linear shock. Okay, so I'll conclude there to keep us all on time. And so just to sort of to summarize, those persistent shocks in human capital seem to be doing everything for the linear rise in consumption. The job ladder is doing basically all of the work for what we see in those skewness and kurtosis patterns. We don't hit quantitatively the magnitudes of the skewness and kurtosis using just the job ladder, and we conjecture that if there's in addition to sort of loss in the search capital, there's something permanent about the individual's human capital that's likely to do the rest of the work. And I'll stop there and turn it over to Erasmus.
Okay, so first of all, I enjoyed the paper. The paper says preliminary and incomplete. My discussion is merely incomplete. So first of all, just to focus on some of the big picture issues of the paper, it deals with understanding wage variation across and within workers. What are the sources of that variation? Human capital, frictions, potentially compensating differentials, so it's that kind of literature. But then obviously also thinking very carefully about the implications for consumption variation as well. What I think the paper, one of the things that I found very intriguing, and is a question that I'm also thinking about myself, is fine, if we're thinking about wage variation as coming from these different sources, human capital, frictions, compensating differentials, what this paper is emphasizing is it's perfectly possible to think about variation in human capital as itself being affected by frictions. And that's what's going to be happening in this paper here, because you're going to be accumulating human capital differently depending on what kinds of firms that you're with. And so good luck, bad luck in your employment history is going to be impacting how much human capital that you have. And so frictions sneak their way in, or the frictional source of variation sneaks in through the human capital channel as well. And so the paper thinks carefully about how important a channel that is, and starts that debate very nicely. This is a point that exists in Lise and Pustel-Vinet as well as in my own work with Nicolas Royce. Yeah, and I think that's a really potentially very, very interesting source of thinking about how frictions impact variation. If you simply just go and do a basic variance decomposition on wages as Graeber and Lise do, you wouldn't capture this because you would just have variation from capital. And so what they do is that they go and do counterfactuals in order to capture this effect. And that's fine. I thought one thing that could be kind of interesting to do in addition is to simply look at how much of the variance in human capital is coming from these different sources of variation. How much is from worker type? How much is from variation in the firm types that you've been with through your employment history? What's coming from the persistent shocks and covariance and so forth. So just take the variance decomposition into thinking about how much variance is there in human capital. And then I think a particular strength of the model is that it doesn't just stop in the debate about thinking about how is variation in earnings impacted by these different channels. It thinks very carefully about the implications for consumption variation. Okay, so let me try and boil down how identification in the model works. So the question is, how do we get at all this heterogeneity, and how does it feed into wages? So the way that the identification works is that there is a basic pre-step where we get the ranking of the workers and the ranking of the firms settled, and then you go on to the rest of the parameters using that basic ranking of firms and workers. And so the ranking of the workers comes from simply looking at the very first wage a worker has entering into the labor market, assuming that the worker is coming from essentially unemployment as your bargaining position. In this model, with this wage determination process, that wage is going to reflect purely the worker's initial type. Firm type doesn't enter into this because it's assumed that by the assumption of how wages are set in relation to output. Then they go on to, so that's sort of first wage out of unemployment. If you have a high wage out of unemployment, you're high type as a worker. Firms are ranked by a poaching rank. I'll get back to that. That's essentially what fraction of a firm's inflow comes from other firms as opposed to unemployment. It's what we call the poaching rank. And then they go on to say, once we have these ranks, how do we identify, in particular, the human capital dynamics? And that's, again, this comparison of 3 successive wages in 3 different jobs. And in particular, if you assume that there's essentially full rent extraction in the middle job, that is, the first and the second job are same types, then the difference between the second and the third job is going to purely reflect whatever human capital the worker has built up between second and third job. It's essentially the same idea as the worker coming out of unemployment. As the worker comes out of unemployment, you have full rent extraction in your unemployed state. Your wage only reflects your own type, nothing about the firm type. The same thing happens if you have full rent extraction in your middle job and you go to a third job with a better firm. Again, the new firm's type doesn't affect the wage.
So why doesn't the first job out of unemployment reflect the product of H0 and H1?
Say that again?
Why doesn't the first job out of unemployment reflect the product of H0 and H1?
Oh, H1 is assumed to be normalized at that point. Everybody starts with an H0.
So the first job out of, like the first job, basically, not the first job out of unemployment, the first job in your life.
The first job in your life. Yeah. I did. First job in life. That's what gets H0. Okay. At some point there will be consumption data, I'm sure, in the estimation. I do think that that's one of the real strengths of the paper, that it has something to say about the implications for consumption. And so right now I don't think it's being used, but I think that's one of the major promises of the paper. Okay. Just as a side note, I mean, given my work on sorting, for example, you may essentially have sorting identified here from the pre-step. So you can go and see how much sorting you actually have in this labor market, and you do have channels in the model that can give you sorting. One is the worker type conditional layoff rates, and another is the differential human capital accumulation across firms that will also induce sorting. Okay. So just to sort of go, so the poaching rank, I was very happy to see them use the poaching rank. It's something that Jesper Baga and I have been pushing for a while. We would love for more people to use this idea of how to rank firms. So this is where I thought I could contribute something. So I'll show a little bit about how this ranking measure actually works. So all you essentially do is you take a firm's inflow from these matched employer-employee data, and you ask of what fraction of that inflow comes from other firms. And then the higher your ranking is, the higher that fraction is, the higher your rank. And this is, in these kinds of models, a theoretically proper way of ranking firms. It's a reveal preference argument. So let me try and show you what this looks like in the Danish data. This is from 1985 to 2007. This is how the poaching rank relates to the wage rank, so the firm wage rank. So higher poaching rank firms, so firms that tend to get their workers primarily from other firms, are also high wage firms. Firms that tend to get their workers primarily from unemployment tend to be low wage firms. This is what the separation rate out of those firms look like as a function of ranking. So low ranking firms have higher separation into other firms. So this is the EE separation. So this is the rate at which workers leave those firms into other firms. So as you would expect in these kinds of ladder models, when you're low on the ladder, you're more likely to accept an offer from another firm. And that is indeed what's happening, with a little bit of noise. Yep.
Can you do the poaching rank per education? Do I find the same ranking?
Sorry?
Can you do the poaching rank per education?
Yes, we could. This is for everything.
I'm asking, do you find the same ranking?
Yeah, we find the same ranking. This is what it looks like for the wage rank. The one thing to keep in mind is this is a noisy measure. There is one thing about these pre-steps that's a little bit concerning, which is we don't really take into account how much noise there is in the estimate of the worker's type, the firm's type, as well as the worker's type for that matter. And so when we go and do the likelihood, as we would in what Graeber and Lise are doing, you're not really taking that noise into account, and that's an issue. So just one more thing. As the worker is, so this is looking at how the worker is moving between firms. This is the type of work, this is if the worker is in a currently the lowest decile firm, this is the destination rank of those moves when he makes E to E moves. And in a ladder model, you would expect that the further up the ladder you are, the better firms you tend to move to, and that's exactly what we see. As we move higher and higher up in the ladder distribution, the distribution of destination firms stochastically dominates.
What's -1?
Sorry?
What's -1?
-1 is out of category. So there are some firms where we just don't have enough hires to properly measure your poaching rank. And so we put those out of category. Okay, so one thing that I wanted, please wrap up, sure. One thing I was concerned about in this is that there is a tendency in the identification strategy towards putting too much emphasis on human capital variation. So first of all, when we're saying that the way that the contracting works is that we're contributing all variance in first jobs to human capital heterogeneity, that's not what would happen in a Pustel-Vinén-Robin setting. Firm type would enter into the wage, and right now that's assumed away. So if you were to allow a different kind of wage setting, you would tend to attribute some of this variation to firm type variation and not just to human capital variation. The same thing happens with the human capital dynamics. Essentially for the same argument, we have no way of understanding downward wage movement except for negative human capital shocks when you're moving between jobs. We have no way of understanding that workers might move down the ladder and get lower wages as a result of that. All of this gets attributed to human capital movements. And finally, the really, really strong force in this model is the accumulation of persistent shocks in the Brownian motion. And so it's said that it's a reflecting barriers Brownian motion in the paper. So I wasn't sure how the reflecting barriers are actually identified. This process is identified only through 3 consecutive wages. There isn't a long-term view of potential mean reversion in these shocks or anything like that. And so, I mean, this is a really important thing. Over time, these shocks get to accumulate, and there is no sense of, say, mean reversion or hitting barriers or anything like that. And that turns into, right now in the model, it's a major source of variation. And so it would be nice to add something into the identification that disciplines that. Okay, thank you very much.